you guys? This is P TV with Tanya and Salita.
What up?
What up? All right, you guys. Today we're going to continue with the business structure from the week before, since we missed last week. And as we said, you can go to sba.gov to get this information. We're going to start off with partnership. The last two on the structure list was partnership and corporations. So, corporations. I said corporations. Yeah. So, what we're going to do is I'm going to start with you, Tanya. You go ahead and get rolling.
Okay, we're going to start with some S corporation. First, I want to let you know what it is. S corporation, sometimes referred to. Oh, yeah, I'm not in this screen. We're using a different film.
Yeah.
The film today. An S corporation, sometimes referred to as an S corp. Let me redo that one. An S corporation. I can't read. Look at my eyes, girl. So we got to get our stuff back. We got to get our regular stuff back. It look crazy. An S corporation, sometimes referred to as an S corp, is a special type of corporation created through an IRS tax election. An eligible domestic corporation can avoid double taxation once to the corporation and again to the shareholders by electing to be treated as an S corporation. An S corp is a corporation with a subchapter S designation from the IRS. To be considered as an S corp, you must first charter a business, so you have to have a business charter, as a corporation in the state where it is headquartered. According to the IRS, S corporations are considered by law to be a unique entity, separate and apart from those who own it. This limits the financial liability for which you, the owner or shareholder, are responsible. Almost like a LLC.
Yeah.
Nevertheless, liability protection is limited. S corps do not necessarily shield you from a litigation such as an employee's tort actions as a result of a workplace incident. So if they get hurt on the job, you still, liable for that.
Yep.
What makes the S corp different from a traditional corporation or C corp is that the profits and losses can pass through to your personal tax return. So this doesn't go on your personal taxes. Consequently, the business is not taxed itself. Only the shareholders are taxed. There is an important caveat, however. Any shareholder who works for the company must pay him or herself, reasonable compensation. Meaning you'll be working for yourself, so you'll pay yourself.
Yeah.
Basically, the shareholder must be paid fair market value. Then you can't cheat the system. What your wage is going to be what the market normally is around. Or the IRS might reclassify any additional corporate earnings as wages. Forming an S corporation. Before you form an S corporation, determine if your business will qualify under the IRS stipulations. To file an S corporation, you must first file as a corporation. So you have to be a corporation first, and then you can become an S corporation if your business fits the profile. After you are considered a corporation, all shareholders must sign and file Form 2553 to elect your corporation to become an S corporation. That's at your IRS. Once your business is registered, you must obtain business licenses and permits. Regulations vary by industry, state, and locality. And if you are hiring employees, read more about federal and state regulations for employees. And also, you can get the licenses and permit tool right here on sba.gov, so you know more about it. Easy access. Now, combining the benefits of an LLC with an S corporation. There's always the possibility of requesting S corp status for your LLC. Your attorney can advise you on pros and cons. So if you're a corporation, you need an attorney. Just a plain LLC is not, if you're small, it's not really required, but you need, it's a corporation,
yeah.
You need an attorney.
Exactly. Especially when you're dealing with shareholders.
Yeah. You have to make a special election with the IRS to have the LLC taxed as an S corp using Form 2550.
Sorry about that, you guys. It happens when you're at work.
It's supposed to do when we make it. Okay. Okay. The LLC remains as LLC remains a limited liability company from a legal standpoint, but for tax purposes, it is treated as an S corp. Be sure to contact your state's income tax agency, where you'll be file the election form to learn about tax requirements. It should be up.
I'm sorry.
Okay.
I'm trying to make sure she's in the picture
Yeah,
because
we
this
can't-
is like a
we-
small screen, you guys.
Yeah.
We're sorry for that.
Okay, taxes. Most businesses need to register with the IRS, which is a given. Register with the state and local venue agencies and obtain a tax ID number or permit. Gotta have that ID number or the permit. All states do not tax S corps equally. Most recognize them similarly to the federal government and tax the shareholders accordingly. Like we said earlier, if you're a shareholder, you get taxed. The actual business is not being taxed. However, some states, like Massachusetts is one, tax S corps on profits above a specific limit. Other states do not recognize the S corp election and treat the business, as a C corporation with all the tax ramifications. Some states like New York and New Jersey tax both the S corp profits and the shareholders' proportional shares of the profits. Your corporation must file the Form 2553 to elect a S status within 2 months and 15 days after the beginning of the taxpayer year, or any time before the year of the status to be in effect. You can go to the IRS, website and read more about requirements for the S corporations. Now we're going to talk about the advantages. Tax savings. One of the best features of the S corp is the tax savings for you and your business. While members of the LLC are subject to employment tax on the entire net income of the business, only the wages of the S corp shareholder, who is an employee, are subject to employment tax. The remaining income is paid to the owner as distribution. Didn't know that. Which is taxed at a lower rate, if at all. Wow. Interesting. Business expense tax credits is another advantage. Some expenses that shareholders or employees incur can be written off as business expenses. Nevertheless, if such an employee owns 2% or more of the shares of that business, the benefits like health and life insurance are deemed taxable income. Independent life is another advantage. An S corp designation also allows a business to have an independent life separate from its shareholders, which is very interesting. If a shareholder leaves the company or sell his or her shares, the S corp can continue doing business relatively undisturbed. That means if you quit, the business can keep going. Maintaining the business that improves the protection of the shareholders. Which is a business distinct corporate entity defines clear lines between the shareholders and that business. So that means that that business will continue to flow as usual, whether you're here or not.
No, exactly.
That's up to you. Disadvantages are stricter operational processes. As a separate structure, S corps require scheduled director and shareholder meetings. More of your time. Minutes from those meetings, adoption and updates to bylaws, stock transfers, and record maintenance. More time, more paperwork, and you got to have it with your shareholders. Shareholder compensation requirements. A shareholder must receive reasonable compensation, so that means you have to pay your shareholder their money. The IRS takes notice of shareholder red flags like low salary, high distribution combinations, and may classify your distributions as wages. So if you're doing shareholder distributions and they are monitoring that, so if you're sitting there, one person's getting too low and the other one's getting too high, or your salary is fluctuating, the IRS is paying attention to that. So just know that that is a disadvantage of an S corp. They are watching you. And they may reclassify your distributions as wages, of course, and you could pay a higher employment tax because of an audit with these results. So you're looking at possibly being audited.
Yeah.
Okay.
For the S corp.
Yeah.
Okay. Now we're talking about partnership.